In this video, we want to consider the impact of speculation on a stock market bubble, the dangerous impact of speculation on stock market bubble. And so one of the items we want to consider here is number one here is driving prices beyond fundamentals. Driving prices beyond fundamentals. Speculation tends to drive the price of assets, the price of stocks beyond intrinsic value. And so speculation occurs when investors buy assets not based on their intrinsic value, but on the expectation that someone else will pay more for that particular asset in the future. This speculative behavior inflates asset prices beyond their actual worth, leading to a disconnection from the underlying fundamentals, such as earnings, such as revenue growth, such as cash flow, or economic conditions. So as more investors jump they jump in, they buy, hoping for quick profit, the price of the asset continue to rise, feeding the bubble as a result. Number two is a short-term focus and risk ignorance. Short-term focus and risk ignorance. So speculative investing is typically, is typically short-term in nature, with traders looking to profit from price fluctuation rather than from, long-term value creation. And so as more people, are engaged in speculation, the focus shift from evaluating companies' financial health to betting on price movements. So this short-sightedness disregards the risk involved, increasing the chances of a bubble, of the bubble bursting when speculative demand fade. Of course, it will always fade. When the speculative demand fades, discover that a correction will set in and the bubble will burst. Number three is hard behavior and amplification of trend. Hard behavior and amplification of trend. So speculation often fuels a kind of hard behavior where investors follow the action of others without fully understanding the risk. They just follow. They go like a hart without considering the relevant risk. As most speculators pile into an asset, driven by fear of missing out, or they believe that the price will continue to rise. Of course, it doesn't happen that way. Eventually, the price will drop. So this amplifies the price inflation, creating a feedback loop that further inflates the bubble until it becomes, unsustainable. Number four is increased market volatility. Increased market volatility. Speculation tends to, add volatility to the market as price, as prices can change dramatically, within a short period of time. The influx of speculators into the market, when speculators come in, they buy and sell based on market sentiments rather than on fundamentals. It leads to a kind of, erratic price movements, which in turn can destabilize the markets. So when the bubble bursts, the market can experience that sharp, sudden decline as the speculative sentiments dies down. Of course, it will always die down. It cannot continue forever. Number 5 is promoting leverage and excessive risk taking. Promoting leverage and excessive risk taking. Speculators often use leverage. That's they borrow money to magnify potential returns, but they forgot the fact that it will equally magnify potential losses when you get involved in margin activities. This increases the overall, risk in the market, as any negative shift can significantly lead to losses. It can lead to significant losses. So during a bubble, leverage amplifies the impact of speculative activities, driving prices higher and encouraging even more speculative buying. There's that hard mentality. When the market corrects, leverage positions are forced to liquidate, excavating the price and collapse. When that dreaded margin cost comes in, people the brokerage houses will sell investors holdings to be able to recover their money. Please like this video and subscribe to this channel. Don't forget to drop a comment in the comment section. So number 6 is the role of media and hype. The role of media and hype. You're living in an age of overinformation, living in an age of real-time data feeds, real-time news. So speculation thrives on media hype and sensationalism. Usually the media will hype a particular asset class, and which can drive further investor interest. And so positive news, rumors or overly optimistic speculative activities, drives prices higher, encouraging more speculative buying. So that is it. It entices more investors to enter the markets. So as the speculative frenzy grows, asset prices continue to rise, often disconnected from reality until the bubble eventually bursts. The bubble will always burst. It can't be sustained forever. It cannot be, it's not sustainable. Number 7 is a mispricing of risk and overconfidence. Mispricing of risk and overconfidence. This market condition is always characterized by overconfidence on the part of market participants. So speculators often underestimate or ignore the risks associated with their investments. They become overly confident in their ability to predict market movement and expect continued price increases. So when the speculative favor ends, the true risk becomes apparent as the market corrects, leading to a decline in asset prices. Number 8 is creating illusion of liquidity and stability. Creating illusions of liquidity and stability. So during a bubble, speculative trading can create the illusion of liquidity and market stability, as the high volume of trading activities can give the appearance of health for healthy and of course a functional market. You discover that there is a heightened level of liquidity, which may not really indicate market health. It may not indicate market health. However, this liquidity is often superficial, driven by speculative trading rather than by genuine long-term investor or long-term investing. So when sentiments shift, liquidity dries up and the prices plummets. So nothing is ever permanent in the market. Prices don't grow to the, trees don't grow to the skies, and the prices don't, continue to grow, to rise irrationally forever. It will always, correct itself. The market will always correct itself. So, in conclusion, speculation plays a central role in creating, stock market bubbles by driving stock prices far above their intrinsic value, increasing market volatility, and encouraging, reckless risk taking. The combination of hard behavior, media hype, and excessive optimism results in unsustainable price growth. It's not sustainable. So to avoid the pitfalls of speculation, investors should focus on long-term fundamentals of the company they want to invest in. So you maintain a diversified portfolio and be cautious, you know, of the usual, overly optimistic market trend. Tread with caution.